All right. Hello, everybody. Welcome to episode number 4 of the Executive Edge. We're here with Philip Chao from Experiential Wealth, and this is going to be a fun conversation today. I'm very excited for this. Philip, you founded Executive Wealth or Experiential Wealth.
That's right.
Tell us a little bit about, who you are, what got you into it. I see you have a lot of books out there. You focus a lot on retirement planning and really kind of changing the thought process of the financial advisor from just checking boxes to really experiencing your wealth, right? So, kind of tell us a little bit about what got you started and how you got into this industry.
It's well, thank you first of all inviting me to be on your podcast, and delighted to share some thoughts and have a conversation. It's a really long story, which I'm just going to shortcut it by basically saying that I started in the financial business through insurance, and then gone into financial planning. I got my CFP, or sort of a financial planning or planner destination designation. Oh boy, I don't even remember how many years ago, many, many, many years ago, and really focused a lot on planning, and then gravitated towards you can do all the planning you want unless you can implement. Planning is just planning. So then I got much more into wealth management and providing discretionary portfolio management, how to invest, how to help people reach their long-term goals. But really a lot of consulting work, a lot of advisory work, helping people to understand what their objectives are and how to reach that objective or those objectives. And so I first started out naming the company Chow and Company, which is fine. That's my last name, but it's somewhat meaningless because if you say, well, what does that really mean?
Hmm.
So one day I kind of thought about it and said, well, let's be more specific. And I changed the name to Experiential Wealth. And why did I do that? Because at the end of the day, after all the work and all the planning, all the conversations with everybody, really it is not money they are chasing after. Of course, money is just a medium of exchange. But really, they are chasing after either they have philanthropic goals or they want to make sure their children get educated and funding for it. They want a certain lifestyle in retirement. They want to help out their relatives, whatever that may be, or travel around the world, whatever objectives they are. They can all be summed up as really they want to go through a certain life experience, right? So it's not what purely for the sake of accumulating wealth, but it's really using the wealth that you accumulate to achieve certain set of experiences or objectives, however you want to call it. So I said, well, let's change that to experiential wealth because it's really we are trying to help clients to reach those objectives in terms of whatever experience that may be. So
All
that's
right.
that's how we came up with that name.
Yeah, and that plays really well into kind of how you mentioned that you're more of a consultant, right, on the
Right.
advisory side. So I guess can you explain a little bit about that when it comes to being a fiduciary, but
Oh,
also being a consultant, right? Because
yeah,
ultimately you have to learn what your clients are looking to experience and
right,
ultimately build something that allows them to live that way,
right.
ultimately.
The word fiduciary, it can be very complicated, it can be very straightforward, but most people are not defining it well enough. So it probably is very difficult to define. I will try to define it. Basically, to serve as a fiduciary is it's serving in the best interest of your client. Now, that's the standard definition. And what does that mean? There are really two uh, requirements. One is meeting the duty of loyalty. I'm loyal to you, meaning that I'm going to do everything in your best interest, right? You want somebody to work for you. And so your objectives is the most important objectives, not my objectives. So that's duty of loyalty. But duty of loyalty alone is not enough. You also need the duty of prudence. Sometimes they call them due care. What does that mean? Meaning that if I never read a book, I never studied anything, but I'm very loyal to you. Well, that's not somebody you want to hire. You really want to hire somebody who understands the subject matter, who spend time to do due diligence and do all that work. so that it is a set of advice, set of recommendations to you that is sensible, that's prudent, that's the right thing for you.
Hmm.
So those two are really important. And then, of course, the standard of care. We want to make sure that we are providing our clients the highest standard of care, which incorporates the duty of due care or prudence. It sounds like a word salad, but it's not. um,
Yeah.
Basically, if you're going to look for somebody to help you, a mechanic, a lawyer, an accountant, a doctor, a dentist, I mean, whoever the professional you're looking for, a business consultant, a marketing consultant. You want to make sure that person is watching out for you based on your set of circumstances and totally devoted to you and not to be conflicted, which is the other side. Well, did he tell me to do this because he or she is going to benefit from it? He or she's going to get extra compensation for it, or he or she will position themselves in a better place somewhere else, leverage of our relationship. None of that is acceptable, frankly, right? So at the foundation of this is really about the word trust. Every relationship, the fact that you and I are spending any time together at all, is we have at least a baseline of trust, right? That defines a relationship. Without trust, it's really a transaction. Even transaction, you need trust, but the kind of trust I'm talking about that has to do with fiduciaries is really complete trust, right? Because you're going to let
Sure.
me know a whole bunch about you, or you're going to hand over your assets. If I'm a mechanic, you're going to hand over your car. If I am, I don't know, a plumber, you're going to hand over your house in making it make sure I provide you the highest quality of work and the highest quality of material based on our understanding of what you want to do. So
Sure.
that's the fiduciary, and I think it's really important. So let me stop there and make sure I did answer it as completely as I can.
Yeah, no, that certainly did answer. And I have a couple other questions. I heard you on another podcast. You mentioned something about, the difference between for the advisor, right? You have to trust them. They have to be confident, but they also need to have humility,
Yes,
right? And kind of know where to draw the line and where to look elsewhere as well. So
yes.
kind of how do you couple that with, you want to make sure your advisor is certified. You want to make sure they're educated. And is there more to education than just having the financial advisor certifications? And how do you kind of balance all that on the advisor side? And how do you balance all that when you're looking for that right advisor for you?
Right. This is a really important question, and I don't think anybody has an answer. Um, we can all get certified. We can all go get more schooling, and we can all pass exams, and then that just means that the only thing about certification is that I have taken the course and I've passed it. That is not enough. At least you say, well, this person hopefully is educated in the area that he or she is accredited or certified in. But that have no discussion about the fiduciary aspect, has no certification about serving only in the interest of the other party. So we can't really have a thermometer into somebody's brain or whatever the thing that we'll probe to make sure that we are seeing him or her thinking in our best interests. So the way to do that, certainly that is important. You want to find the people who have devoted his or her life to that profession, right? And that they have passed exams or certification that at least give you first layer of comfort because you're basically building trust and reliability, right? So to build that, first you have to be a credible source, and the credibility comes from certification and passing certain type of exam. But it should not be held as the only standard. Because that it just simply say, well, we got somebody who's really good in taking exams. that doesn't
Mhm.
that doesn't mean anything. So I think experience certainly is true, but I can just imagine people listening to this podcast say, well, how would I ever get there if I just starting out as a financial advisor or planner or wealth manager or what have you? I don't have 10 years worth of experience. I just starting out. It's one of those old stories that somebody graduated from college and went to go look for a job, and they said, well, no experience, I can't hire you. Well, if nobody ever hired me, how am I ever going to get experience? Right. So I understand that issue. But what happens is for those who are working with teams of people, then we should check out their team, check out their company, and really important to ask them for references. And of course, they're not going to give you the references of people who are really upset at them. They're going to give you their best references. And knowing that, you got to discount the statements of those references. However, I think you should contact them and ask them probing questions about the character, right? About what the psychological makeup even of that individual. And it is through those probing questions, because you no longer need to ask about credibility or credential, because oh, behind his name, there are 18 different things behind his name. So, okay, great. I assume those are all true, but still, I don't know anything about that person. Because what you're doing is inviting somebody in to be very, very intimate with you about your finances. And you're relying on him or her to guide you, and you give him or her utter trust. So, the key to your kingdom. Well, if you're going to give your key to your kingdom to somebody, I think you need to do as much checking and verification as you can. Even with that, the best of the best in, uh, I don't know, in not being honest, they know what to say and they know how to do it. So let's be careful that the people you like the most, because they are very good in emotional intelligence or they're very good with people skills, may or may not be the best advisor for you. You say, well, hold on for a second. Do I want to find somebody I don't like? No, no, no. But don't get overwhelmed by the individual's personality or the ability to relate. They tend to be great salespeople, which we appreciate very much because we're having a conversation, we're having a relationship. But you're not hiring a friend, you're hiring a professional, right?
Sure.
So we want the most competent doctor to take care of us, but we would love to have good bedside manner as well.
Hmm.
But if I have to pick one and the other, I rather have a very competent brain surgeon than a brain surgeon who can really wow me by my bedside, if you would, if you know what
Sure.
I mean. So I'm sorry, I just keep going on this idea, but it's a very difficult task to immediately identify an individual, a firm that can definitely be the right person for you.
Sure. And you said something interesting, again, how the certifications aren't essentially the end all be all. Now,
Right.
that's the consumer side. On the advisor side, what other education, should you be attuned to? And as a consumer, what should you look out for rather than somebody who knows how to check the boxes or circle the right answer? What type of competence would you look for in that? And as an advisor, what type of competence would you look for when you're educating yourself?
So let's say if I'm looking for an advisor, I want that advisor to really understand me. And depending on the questions that you ask, you will know how well can they relate to you and have empathy and understand what you're looking for. So I want to give an example. If you and I decided to go build a building together, and so we go out there and find a couple of architects, right, to design the building. The architect's job is not to build a building that he thinks is best for you. He should be building a building for you, right? Let's say you want a humongous bathroom, and that's what you want. Half of the house is one bathroom. That's what you want.
Sure.
Yeah, it's bad for you. Nobody, you will have a low resale value. But you say, hold on for a second. It's my money. I get it. I understand all the problems. You have told me all the problems. I still want that bathroom to be half the size of the house. I'm being ridiculous. But there are architects who will just build it in their own image, which is inappropriate because all they are doing is building a house for themselves to live in.
Hmm.
Our role is to build a house that you want to live in, that is good for you, right? So if I take that example further, I will definitely persuade you not to build a house. Well, half of it is one big bathroom. There will be times that I will see a client that there's no match. I would politely and respectfully say, "I'm sorry. This is your expectation. I don't think that I can fulfill.
Sure.
You need to find somebody else, right?"
You don't want to be
If
responsible when they try to sell it and then they realize they can only get $1 for it.
I'm not going to encourage them to go down the wrong path, but I'm
Hmm.
not going to stop them from going down the path they want. They just have to find somebody else who's willing to do that for them. Does that make sense?
Sure. Yeah,
Right.
definitely does.
So not everybody who comes in the door can be our clients or should be our client. Let me not say can be, should be our clients, right? That there is a certain matching that goes on. Otherwise, there will only be one financial advisor or one wealth manager because it can satisfy everybody.
Sure.
And that's not true. So I think number one, I think having the compassion, the empathy, the understanding, and the emotional IQ, those are all soft skills. You don't learn that by certification, right? You learn that by being open-minded, by experiencing, by learning, and to have field experience. It's one thing to learn how to ride a horse in a book. It's quite another thing to actually get on the horseback and ride the horse, right?
Sure.
So we want that person to ride as many horses within reason as we can. And if that one person hasn't not ridden enough horses, but he belongs to a team that owns a horse farm, that's good enough.
Hmm.
I mean, from that standpoint, because it's not a single person, it's a group effort. Does that make sense?
Sure. No, it does. It's a matter of having a team around you, right, that can kind of make up for your shortfalls,
Correct.
right?
Correct.
And making sure that it's not only them, it's again whoever they have to call on when the time permits.
Correct. Or they bring in a team that no one person is perfect in all things. And the team certainly has a team leader, but it probably have one or two other individuals who they can bring in for areas that they may not be the most well versed in, so they can bring in other people.
Sure. Sure. And going into our next topic here, I think you'll really enjoy it. Considering again, you are an author, you do write a lot about our current environment, you give us market updates. With all that said, why is I guess tell us a little bit about why it's so important as a consumer, right, to do that last step, right? Find that right advisor that can understand their goals, does have the resources around them, if not them themselves, right? And what does today's snapshot look like in macro, micro, in the economy to make it that much more important than not relying on old methods and the fact that you do need somebody who sees everything as a whole.
So in the last 25 years, we went through a lot of ups and downs in the market. When I say market, I'm talking about the stock market and the economy. I mean, it went from 2000, the tech bubble, and then we went through, the great financial crisis, and then we went through COVID, and and other things in between. So what we have learned from all that is we can never have overconfidence bias. We should not have overconfidence bias. Oh yeah, I know what's going to happen. That's the last thing you want to hear. So we go back to a word that you mentioned earlier about humility. And we always think that, the 50-year flood or whatever, it happens only one in 50 years. It happened every 5 years, every 10 years. So we worry about what we call left tail risk. So let me just make sure we're on the same page. Typically, most people think about a normally distributed curve, which is the bell curve. And most people have seen that if they took high school math. When most people are in the middle here, and there are people who are on the tail end. So an event, typically, most people are, let's say from a height standpoint, most people are between 5 and 6 feet, let's just say, okay? Are there some people sub 5? Yes. Are there people above 6? Yes. But those are tails. But it's pretty normally distributed, right? Your average people is going to be in the middle, and then there are some shorter people and there are some extra taller people.
Sure.
the world in finance and economics have nothing to do with the normal distribution at all. Right? The volatility and events that we do not anticipate, um, events that happens that either like storm and weather events, or political events, or geopolitical events, or military events, COVID events, all those type of things. It has two tails. It has the left tail, which is the really bad stuff, and the right tail is really good stuff. We
Hmm.
want all the right tail. We want, oh my goodness, I won the lucky lotto. That's a right tail event.
Yeah.
The left tail events, oh, COVID hit, right? So in investing, we need to be humble. We need to understand, yes, history rhymes or repeats itself, whatever version you want to use, but not exactly. And so we operate in a average mentality. On average, this is going to, well, average means most of the time it's better or worse.
Hmm.
We don't live in a really average world. So, to answer your question more specifically, we are experiencing seemingly a higher degree of uncertainty in the economy for all kinds of reasons. And that because of the uncertainty, we need to be more careful, right? Now, when we're younger, we can afford to take on that uncertainty or risk because we have a whole lifetime ahead of us to make up for any losses. And it is long-term investing. We're going to go through ups and downs, quite understandably. But as you get closer and closer to retirement and beyond, then you have to be really careful because there's no coming back. Well,
Yeah.
if you suffer a significant loss, you suffered a significant loss. Why is that different than significant loss here? Number one, you're not making any more contribution reinvesting anymore. You're taking. And when you take, you're withdrawing when something goes down.
Hmm.
You're not buying more at the low, you're selling at the low, which is always a problem. So
Sure.
we need to be, our framework changes, morphs over one's lifetime. Those are things that, of course, advisors and wealth managers and investment managers should be very cognizant of and very careful of. So we do want to have some kind of viewpoint to overlay on your portfolio to think about the future. But think about the future without ironclad confidence, because any plan is only as good as the assumptions coming true.
Hmm.
And most of the time, not all assumptions come true.
Yeah.
So there's always a left tail risk, and we need to be careful. Why am I keep emphasizing left tail risk? Is because right tail risk, we love it. We love the right tail surprises. We are really trying to manage that that portion. And the better we manage it, the better and the more stable the way forward it is.
Sure. And with that said, I mean, what do you think investors, advisors alike, right? What do you think they're still misunderstanding? I mean, both not only in the retirement aspect, but just in general when investing in the market. What do you think is like a misunderstood in today's climate?
I think the current climate is a climate of uncertainty, as I mentioned, but future is uncertain, right? There's nothing new about what I said. I mean, you go back a million years ago, we'll still say it's uncertain
Sure.
because we cannot tell the future. So anything we cannot tell is uncertain. But it's
Sure.
a matter of degree of uncertainty, right? So there is a significant shift in the way the world is running from a post-World War II environment, where U.S. has been the unipolar world, the leader of the unipolar world, whereas we are the unipole,
Hmm.
to a multipole. There are changes globally that we have not, and nobody alive practically have experienced it, right? So we are going into we're going to a regime change, shall we say. And this regime change takes time. It doesn't happen overnight. And it's going to take a period of time to morph to wherever that new destination is. US still play a very significant role, but not the sole role, which is the unipolar world. right? Because we were number one after the Soviet Union went away, so to speak. I mean, we were the king of the world. We are still a king, but may not be the only king of the world. And that
Sure.
changes. That changes how we think about the outside and how outside think about us. I mean, the trade issues, the our reserve currency issues, the new thing, the stable coin that we are championing, and the whole digitization of financial assets, and which ultimately lead to everything that we do is going to be on chain, which is blockchain, and how all that can affect both positively and potentially negatively is yet to be completely understood, right?
It's
So
uncertain.
uncertain. But through uncertainty comes opportunities as well, right? It's not always bad, it's not always good. I just had a conversation with somebody who was asking me for career advice. And the two things that I reminded him that I learned is two things. One, always reserve optionality. We can pivot. We as much optionality as we can on decisions. And number two, every decision we make is about trade-offs. And trade-off has to do with assumptions. So the better assumptions we can make, or more reliable, that the outcome is going to be the assumptions that we assumed.
Hmm.
If it's realized, then we're in a good place. But it's about trade-offs. You can't get everything. The question is what type of trade-off you should have. So a good advisor is not just telling you, hey, you need to do this, and this. Sometimes that's true. But also, the good advisor should also say, here are two, three possible outcomes. This outcome will happen to this to you and that to you, this outcome, this to you, and so on and so forth. Let's talk it through. Let
Sure.
you be the driver. Because at the end, I'm building a house for you to live in,
Hmm.
right? So if you're going to live in it, I won't be around. I'll be in somebody else's house building it, and you have to live in this house. So you need to really understand what the trade-offs are, and are you willing to accept those trade-offs, right? And then during the trade-off, you also want to have maximum optionality. If all the assumptions wrong, do I still have an escape route? Do I have a plan B,
Sure.
plan C, right?
Sure. So I guess, go ahead.
So all that talk sounds wonderful, but in practice is very difficult because you don't get something for nothing.
Hmm.
Everybody wants the highest performance and the least amount of risk. That sounds like a perfect investment. There's no such thing. So for
Yes.
every bit of covering the downside, you're also eroding on the upside, right? Because you're so worried about this tail, you're not going to be willing to take on enough risk for the upside to happen. But if you
Hmm.
just emphasize the upside, watch out for the tail. It's going to come and whack you, so to
Hmm.
speak, right? So much of this discussion and building portfolio is not the modern portfolio theory and looking correlation and blah blah blah. All that is important, but really educating the client to understand, to manage their own expectations, and to understand how this dynamics and the balancing of risk and return, right? Rewards and objectives and all these things trading off and make a conscious and well-informed decision. That's our job. Our job is not just to give you here's the prescription. Go to CVS or wherever you go, Walgreens to get, and then pop one a day and you're going to be fine. That's not what we do. We shouldn't be doing that. What we should be doing is that here are all the possible, realistically, based on our understanding of the situation, here's the possible outcome based on that set of assumptions. And I will tell you, if these two assumptions go wrong or it doesn't happen, this may happen to you, and so on. So, what we are doing is analyzing it for you. What we're doing is advising you on these different trade offs, but the decision is yours because you live with those decisions. I'll stop there. So,
Sure. No, I love that. I love that. I mean, ultimately, there's always going to be uncertainty, like you said, from today
right.
to a million years ago to a million years from now. It feels like, and that kind of hones in on my next point. There's always going to be uncertainty. Our job or your job is to just help or try to decrease that uncertainty and give the client, in this sense, the optionality to decide which route they want to go ultimately.
Yes, yes, yes. I have a client today. This is a real situation. He sends me a note and say, "Hey, there's this particular ETF, exchange traded fund, on crypto and digital assets." His question was, "Do you think we should invest in this?" And I don't have an answer. You should or should not. So my answer to him back is that I looked at that one, and I happen to know the one that he was talking about because I actually met some of the folks who are promoting that product. They actually have three different products, all with them. They're sub-advised to this particular product. And so I said to him, I said, well, crypto and all this is really the promise of tomorrow, but there's still a lot of risk related, and that we're making a assumption, although it's the general everybody's assumption that that's where we are going, but there are going to be a lot of hiccups along the way. So let me be clear. I don't know if this particular investment is going to pan out the way you want or not. If I know, I will tell you, right?
Sure,
Nobody knows. So there are going to be mistakes along the way. That is within that investment or the market itself. Let's say a new policy came out of the White House or a new policy come out of SEC or whomever that we didn't know. Bang, it happens.
hmm
It could have a dramatic impact on this sort of a new area of investing.
Yeah, one of those two wings, right?
Right, exactly. So the question I asked him back is if you're willing to take on this risk, and we don't know what that risk is because this is such a new thing, right? Well, I can tell you all the PE and that people are talking about it being a bubble and so on and so forth. If you take a look at all that, then you realize that there is a lot of risk as you go into it when the price is already pretty high and going into an investment that has not been proven over time that it has a certain way of moving forward or where it could go. Doesn't mean it's bad investment. I want to make it clear. I'm not here to knock it or to support it, but it's no different than any other investment. The question then is, if you're willing to take on that risk, what is your objective of taking that risk? Is your objective taking that risk for gain, or are you trying to add more diversification into your portfolio as
Sure,
additional? What is it? And what is your expectation? Finally, once you have decided that, then the talking, one of the most difficult thing is sizing it. For $100 is all you have. How much of that $100 you want to put into this thing? I want to put $50. I think it's all too much.
yeah,
but if they say, look, I want to put $5, okay, then you just want to sort of have a little bit of taste first and see how it goes, and then you may want to put more in. I have no objection to that. Not an edict, not an what is it you want to do, why you want to do it. Are you attracted to it because of all this noise out there? Or is there a real reason you want to do it? How much do you know about it? At the very end, how much money are you willing to bet on this horse?
sure. It goes back to that consultative approach,
Yes,
right?
exactly. Exactly.
And so I guess with that said, zooming in even more, what are your thoughts on, again, going back to what it was and the changing environment we're in? It was always the 60-40 approach,
Mhm.
60% stocks, 40% bonds. That was the rule of thumb. Pretty much there was no more depth to it than that. Do you believe in that now? Or if not, what's the new way to look at it? I know we're going to go back a lot into things you've already mentioned, but just to touch on, for people who are looking into retirement now in the next 10, 20 moving forward, years moving forward, what's the way they should look at it? Should it just be that simple, or is there a little more depth to that?
You may want to ask me that question again because I lost a lot of it. So let's start of
Okay.
you asking me about the 60/40, and
Sure.
yeah, please.
Yeah, so diving into that even more specifically, the old school 60/40 approach, 60% stocks, 40% bonds.
Right.
With kind of everything you just mentioned, and for people that are thinking about retirement now or just saving for their retirement, is that approach, is it still that simple, or is there more depth to it? And especially for people, that are closer, 5 years, 10 years, or
Yeah.
even closer to retirement,
Yeah.
should they be reanalyzing that portfolio, or at least trying to find somebody to work with that does think a little bit deeper than 60/40?
So, if I may rephrase that question in a different way, if that's all right with you.
Sure.
What you really are asking when you talk about 60/40 or 40/60 or what have you, you're really talking about risk management. How much portfolio risk are you willing to take? So just for the audience, 60/40 means 60% in stocks and 40% in bonds or fixed income. And typically, fixed income is the less volatile, more certain income generating assets. And stocks is about the future, the growth, and all that, and where you get the most of the juice, shall we say, the return is from stocks because at the end of the day, we all kind of intuitively know that return has to be commensurate with risk. Otherwise, nobody would take risks if there's no return, right? So the question is, how much risk? That when you talk about 60/40, which has been the classic institutional portfolio standard, where 60 cents on each dollar goes to stocks and 40 cents on each dollar go to bonds. And why it has worked is because it traditionally, stocks and bonds have not been moving in the same way up and down. When bonds go up, stocks go down, or when stocks go up, bonds go sideways or down, because they are what they call not correlated to each other. That's where you get the benefit of diversification, right? The diversification meaning that when this doesn't work, the other one is working. When this one is not working as well, that one is working. That's the idea. But if they are all working good and bad together, you have lost that diversification benefit. And most recently, because the inflation interest rates have went pretty high, 9% also under the current Federal Reserve, and then it's starting. But before then, it was ramping up quite a bit, quite quickly. And so the market was hurting because the interest was going high and in a pretty speedy manner. And that created a positive correlation of stocks and bonds. Both came down, right? So those are not happening all the time, but it's not unusual that stocks and bonds sometimes are correlated. You go through in history, if you go back and look at the correlation graph, it's not true that they have not been correlated before. It's just that people don't talk about it if they're correlated together going up. Everybody's excited. Oh, it's going up. I don't care if they're correlated or not correlated. It's only when they are both coming down together that's when people say, "Oh my goodness, that's terrible. I mean, stocks and bonds are not working the way it should, and they are highly correlated." Well, hold on for a second. They were highly correlated when both of them were going up too, right? So yes, I don't think it's anything new per se. So as we get closer to retirement, I'm saying closer as in the last 10 to 15 years, we really need to be very cautious about the amount of risk we should take. Why do people take a lot of risk at the end? Because they didn't save enough. They say, let's try one more time. Let's cross our fingers and hope to die. let's let's put more risk into our portfolio, and hopefully we'll make up for some of the lack of savings we have done, and go for the last Hail Mary shot. Well, you know, Hail Mary shot not always going to get you over the goal. Many
Sure.
people just not make it. So that's a dangerous way of thinking, right? So under normal circumstances, we encourage people to think about the level of risk they should be taking. It's really about level of risk they should be taking. And if they agree that they shouldn't be taking that kind of volatility, then it's naturally going to be less equities or less stocks. But today we have private markets and public markets. Private markets becoming a bigger and bigger thing. I'm not here touting that they're good or bad. I'm just saying there are different markets. Private market meaning that it's not something traded every day and doesn't have liquidity every day, meaning that if you want to sell it, you can sell it. You have to wait. It doesn't give you cash for whatever you invested. But private market assets and public market assets, they work in.
Oh, I lost you again.
I think the inflation is around for a little higher for much, much longer.
Are you cut out? You said public markets and private markets. Neither
Right.
is good or bad.
Neither is good or bad. And they sometimes work exactly the same way, sometimes they don't. So there's diversification benefit. And also there are opportunity benefit. There are certain opportunities available in private market that are simply not available in public market. For example, there's a lot more companies going private than going public. When I say going private, staying private. And that's where the private equity firms and the private market investors capture those companies and buying them out and managing it rather than going public, meaning going on the stock market the traditional way as an
Sure.
exit strategy. So private and public give you some diversification, both in the equity standpoint, which is owning stocks of public companies vis-a-vis owning stock of private companies. And then there's public market for fixed income bonds and private market for fixed income bonds. So that's one type of diversification that may make sense. I'm not giving advice here. I'm just saying that those are different markets. They have different attributes. Another area that I think inflation is going to be around for much longer, and with all the energy transition and with all the AI build and all the CapEx, capital expenditure into building data centers and all that, they all require energy, and our energy grid is pretty old, and there are a lot of investment needs to be made. So infrastructure is a huge area that is worth taking a look at, both in the private and the public side. And you carry that story further, anything that about energy and about all that, we also think about minerals and commodities, right? If there's a tremendous demand by the Trump administration to bring manufacturing back to this country, assuming that's successful, meaning we're going to build a lot more factories, we had to build buildings, we had to use cement, we had to use copper, we had to use, all kinds of stuff. And that will drive the commodity prices higher because of supply and demand, very simply. So commodity is something to think about, as part of an inflation hedging uh, investment asset class, which is different than stocks and different than bonds, right? So those are things that I think one should think about, and to create a portfolio that is all what they call all-weather portfolio.
Hmm.
But an all-weather portfolio is a portfolio that when your neighbor or your brother-in-law is beating his chest, saying, "I made 36% last year," and you looked at your statement, you made 8. You said, "My God, am I an idiot?"
Hmm.
He is also the idiot who have lost 53%. He didn't tell you. Okay, so never compare your performance with somebody else. It's not important. You don't live somebody else's life.